John's Trimming Service. Step 1. Analyze the transactions. Transactions are anything that changes the company's assets, liabilities, or owner's equity. Some examples are buying supplies on account, expenses, and sales. Here's some examples. Some source documents: a receipt, memorandum, sales invoice, and check. Step 2. Journalize and record transactions. Journalizing, journal, source document, some examples we talked about earlier. Here's my journal. Post journal entries to general ledger. The ledger is basically financial accounts of all the business actions containing debit and credits. Here's my general ledger of all the different general accounts, from supplies, accounts payable, prepaid insurance, advertising expense, accounts receivable, and cash. Next step, prepare a worksheet including a trial balance from the general ledger. My income statement. It's pretty much a financial statement showing the revenue and expenses for a fiscal period. So as you can see, I had a net loss for my business because of my expenses were greater than my revenue. The next step is filling out a balance sheet. It's a financial statement that reports assets, liabilities, and owner's equity. My assets are higher than my liabilities, but that does not mean that I had a net income. Next step is closing entries, is journalizing and post-closing entries. Here's my post-closing entries of all the different accounts that go along with the closing entries. Here's my trial balance. This is the last step and most important step to see if your business does, at the end of the accounting period, become equal. And if it's not, you're gonna have to do cash short and over, which make your company's amount of money equal.